time, thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, Dimitri Pogomonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's a disclaimer.
Excellent.
And let me see. I'm going to share my screen here. If anyone has a question out there, you can put your question on the live chat on YouTube, type it in. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once you come in, everybody could hear you. You could ask your question direct and live. While we're waiting for any questions to come in, I'll start out with the pre-market report. We'll take a look at what's trading in pre-market hours. Then we'll navigate maybe to a couple different reports, see if we could get some insights. I'll see, maybe I'll take a look at, an options report, see if we could get some insights from there. Okay.
Perfect.
So pre-market report, these are stocks trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 62 stocks made our percentage gainers list, 29 stocks on our percentage decliners list. So from this perspective, looks like a more bullish bias at the open. Let's take this list and filter it down to only S&P 500 stocks. To do that, I'm going to use this filter here in ETF. Drop it down. I have a list of, ETFs that I could select from. When you select one of these ETFs, the report below will get filtered by the holdings in that ETF. SPY over here, that's the S&P 500 ETF. Let's pick that. And when we select that, you could see that the list below gets filtered out by the stocks that are holdings in SPY, which are the S&P 500 constituents. And here we see 4 stocks made our percentage gainers list, 5 on the decliners list. Really mixed bag, pretty even here. So no real bias in the S&P 500. We did get a sell-off yesterday. Seems like right here we're kind of maybe in unchanged, close to unchanged. If there are no questions, Will, what I may do is, I'll take a look at the ETF screener quickly and then move on to an options report.
Perfect.
All right. And a couple things, interesting right now that are going on. We see a lot of volatility, and we've been talking about volatility increasing as interest rates go higher and the Fed pulls liquidity out of the marketplace. That will start creating more volatility and higher bid-ask spread in risk assets. Okay. And when I talk about bid-ask spreads, there's 2 kinds. Obviously, there's one where you get an immediate fill, but then there are also where a lot of money has to move in and out. And when that happens, we see increased volatility. So if all of a sudden, a lot of money has to move out, the real bid is much lower. If it has to move in, it's much higher, creating greater volatility and much wider ranges of entry and exit points as far as large money has getting in and out. And a few things that are going on here that are interesting, because as interest rates go up, it's harder to price things, it's harder to forecast, and sometimes you start seeing these dislocations in assets. And one thing that I'm noticing is when the market right now is kind of lining up where, well, the Fed has maybe done enough. They're winning on inflation. They may win, and then we're going to have to go back down in interest rates. And what's going on is we see the 10-year bond, the 10-year Treasury, I think is back down to 3.5%. So at this point, the 10-year interest Treasury yield is below the 2-year. It's below the 1-year, and it's going to be below the risk-free rate in December when they take it up another 0.5%. So it's going to be at 3.5%, and the Fed funds rate is going to 4.25% and going higher. And all this is kind of in anticipation that, okay, well, the Fed will beat inflation and they're going to slow down the economy. So they're going to be forced to take the interest rates down really, really hard. And here I'm going to go into asset flows just to give you a demonstration here of what's going on. So these are inflows and outflows into ETFs. And I'm going to look at the 1-day change, the biggest one. And we see here SPY yesterday, a net inflow of 1.6 billion. So even though the market was down, inflow was up, 1.6 billion. TLT, that's the 20-year Treasury ETF, inflows here 1.6 billion. 7-10-year Treasury 1.3 billion. Obviously, when people buy bonds and drive bond prices higher, the effective yield goes down, right? So think of coupons. If you have a fixed coupon and that pays a fixed amount over time, if the bond prices, if the price you pay for that bond goes higher, then the yield on what you're paying is declining, right? Think of it like a dividend yield. If you pay fixed dividend, the higher you pay for a price of a stock, your dividend yield declines because you're paying more for that stream of cash flow. All right. And the weird thing about this is the following, that as yields go down, 10-year goes down, and as the market goes up, that itself is creating inflationary pressure, right? So if the yields go down in the 10-year, those longer-term borrowing costs are going down, and you could pay more for whatever you're borrowing, mortgages. Also, what happens is the dollar starts to decline. Dollar declines, that's inflationary, because now it takes you more dollars to buy the same good. And as the markets go up, right? As the markets go up, that's also considered an inflationary pressure. Why? Because if your portfolio is gaining in value, you log into your brokerage account. What do you see? You see your wealth going up. If your wealth goes up, you feel more confident. If you're more confident, you're more confident to go out and spend money, right? You could even borrow against your portfolio. You could sell and spend money. So those are actually things that the market is doing that's working against what the Fed is trying to do. And that's why sometimes we say that the markets are almost fighting the Fed, because the Fed is indicating we might slow down how we're increasing it to look at the data, but they're not done, right? They're not.
I thought we learned never to fight the Fed.
Never fight the Fed. And I think what's going on here is that the Fed, and it might be their credibility, it's an issue of credibility, we talk about where they held the interest rates for such a long time at such a low rate that the mentality is that is their real target. Their real target is that they're going to, you sell your assets, you get into cash, and the Fed will just pull the rug right from underneath you and inflate really quickly. I think that right now is a bigger fear than a recession. That the Fed will just turn around, do a 360, and just say, well, you know what? We're going back down in interest rates really hard, and we're just going to inflate, right? And that's keeping right now, I think, part of what's going on in the 10-year bond, part of what's going on in asset prices and real estate price. People are holding on, and probably justified, because we've seen the Fed give us a real look at, they're very loose with inflation, very loose, right? Like, that's why we're in this situation, that in reality, maybe that is where they err. Maybe the markets are signaling that the Fed's target rate is not 2%. Maybe it's going to be higher. Maybe that's where that's the aim. Maybe it's 4% or 5% or 3%, or they'll let it run for a while. Because certainly, if you listen to the Fed and you're seeing what the markets are doing, it seems like the markets are kind of fighting the Fed in this instance. What do you think?
Yeah, no, it seems that way. And I mean, on the way up, you were alerted to never fight the Fed, right? And it's now going the other way.
It's going.
I mean, listen, the difference, I guess, being that every paycheck, money has to be invested into the market, right? Unless everyone who has a 401k has put it into cash or bonds or whatever, unless they change how it's being administered or what it's being invested in, there is an innate buyer that shows up. But it's a period to certainly be careful and know your downside risks.
Right, and that's a good point. Was making that when you study inflows into the market, right, and where they're coming from, and and there's certain streams of inflows that are pretty stable and consistent, right? They're going in from people's paychecks that sign up for the retirement plans, pension plans, savings plans. Our system is built in a way to incentivize that, right? So every month or every 2 weeks, I don't know how, everybody might do it a little bit different. We're at full employment, and when we're at full employment, some money is constantly getting taken out of people's paychecks that's getting then invested into mutual funds and those types of investment vehicles that find its way into the market. So that is another thing that the market right now is actually benefiting, because while we're at peak employment, or what they say is like at complete full employment, well, we're also benefiting from that there's a big amount of money flown into the market right now from people being employed. So that's another definitely bullish pressure coming into the market. And on top of that, I think that the rate of secondary offerings and IPOs has declined, right? So I think the inflows are kind of staying the same from that perspective, but the supply of stocks has been declining coming into the market. So that is creating some bullish pressure on stocks. There are no questions, Will. I'm going to move on to some option reports.
Yeah, move on.
All right. Let's take a look at this report over here, the straddles, and I'm going to try to visit it once a week. And if you guys recall, what this is doing is looking at options. It's capturing them from Monday morning. So it takes the very near term options expiration, looks at the markets Monday morning at 10 a.m., and then follows them till the Friday's close of that week to see how the options performed for the week. And it keeps and then it does that every week to see how the straddles performed, out of the money calls, out of the money puts. And here we talked about a couple different ways to look at it. So look, we have these types of strategies: straddle, 25 delta call, 25 delta put. So I'm going to compare these right now. At the money straddle, 25 delta call, 25 delta put. So I'll leave these alone. And then we talked about different hedging strategies. So a hedging strategy would be when you first put on an options trade, that option itself has a delta, which is a risk exposure to the direction of the stock for a $1 move. Okay, so a positive 50 delta means that that option will, if the stock moves up $1, it's expected to increase by 50 cents. If it's down $1, it's expected to decrease by 50 cents. And then the delta is changing as it's moving. And we use the gamma to see how much it would change by. But let's just stay with that delta for now. A negative 50 delta would mean that the option will be, for $1 stock move to the upside, the option will decline by 50 cents. And if the stock moves down, it will increase by 50 cents. Okay. Now some options have, smaller deltas like 25. So these are when we're talking about these 25 deltas, that means it's an out of the money call. And a 25 delta, what does that imply? That if the stock moves up $1, that option is expected to increase by 25 cents. If the stock moves down $1, it's expected to lose 25 cents in value. Okay. So you would have to hedge the appropriate amount of stock to offset that risk in the option. So what we want to see is, well, which option was better? Was it better to buy a straddle, buy a call, or buy a put if all you wanted to do was stay delta neutral from Monday to Friday? In other words, if you were aiming just to trade the implied volatility versus the realized volatility, which strategy would have been better? Doing that the money straddle, or buying the put and hedging your delta and then rehedging every day, or buying the call and then hedging it and then rehedging it at the end of day every day? Okay, so we're going to pick daily rehedge. Okay, so this is showing us the at the money 25 delta call, 25 delta put for each stock. So right now it's sorted by highest market cap. And for each stock, we should have 3 different strategies to compare, right? At the money straddle, 25 delta call, 25 delta put. And then I'm going to go over here. This is the market cap, average daily volume, spread in the option. And you could see here in Apple, the straddle has a 4-cent spread because you're buying a call, buying a put, so you're really doing 2 legs there. So the spread in that strategy on average was 4 cents, but the call itself was a penny, put was a penny. And now we could see which one did better if we took all 3 strategies and basically at the same time at 10 a.m. we put those strategies on, hedge the deltas, and then at the end of the day, wherever the stock moved, we rehedged the deltas, and then we did that every day till Friday. Okay, and you could see here that in the last 12 weeks, all 3, half the time were profitable, half the time were not. All right, so as far as frequency of wins, it's a tie. Half the time they were profitable, half the time they were not. But what was the average return? Right, because in options, the profits could be very high or very low. So there's a big dispersion. So the average return for the at the money straddle was plus 18%, right? So if you did it week after week after week for the last 12 weeks, you lost some weeks, you made some weeks, but at the end of the day, on average, it was an 18% return, trading implied volatility versus realized, which means that the implied volatility in Apple was underestimated on average in the last 12 weeks. Not every week, but that was the averages, okay? If you did that same strategy, but you said, forget about the straddle, I'm just going to do the same thing, but using the 25 delta call, okay? So I'm going to buy the 25 delta call, hedge it, and every day, I'm going to wait till the end of the day, the stock moves, there's a new delta, I'm going to re-hedge it. The next day, the stock moves, there's a new delta, I'm going to re-hedge that. And then on Friday, at the end of the day, I'm closing out of that position. So the average return on that strategy was 36%. So you could see here that it was, from this perspective, if all we're looking, now we have other metrics here, but if all we're looking is at these two metrics, then this one looks better, right? Because at the same period, I did the same strategy, I just picked a different option on the board. That was a 36% return. What about the put? So the put, 50% win rate, 50% lose rate, but the average return was 56%. So actually the put, so far from this perspective, was the best choice if you were looking to trade the implied volatility versus realized volatility strategy. Okay. That was the best choice. And maybe, Apple has maybe like a flatter skew. And when it goes down, the implied volatility goes up. So there could be some explanations, but that's what it's been shown in the last 12 weeks. And if you wanted to look at the data, you can open it up and go into here. But let me continue on this, and then maybe we'll look at the data. So what about the median return? And the average return we talk about can get skewed, right? So if out of 12 instances, if you had one really big winner that pulls up the average, so then we want to take a look at the median return to see, well, what about the return right in the middle, where half of them were below this, half of them were above this, okay? Here, we get a little bit of a different story. The straddle, the median return was 8%, versus an average return of 18%. The median return for the 25 delta call was negative 12%, versus an average return of 36%. So this is telling me that there could have been a really big move out there, an outlier or whatever that pulled up this average. But you could see that the median return was negative 12. On the put side, here it's a better story, 46% median return, right? If we go down here's the week to week, right? So these are the start of the week. You could see here, this is the end of the week. These were the expirations we used. And here are the prices, start of the week, right? So this is the put price, put premium. Oh yeah. So right now I opened the put. Okay, so we're on this put. That's the view. So this is where the put price was start of the week. This was the put price end of the week. So you could see here that the stock went from 145.97 to 147.82. It went up. So this put, the out of the money put 142 went from 98 cents to 0. So the put itself became worthless. But remember, we were also trading stock against our delta, right? So if all you did was the put, you could see that you just lost the entire amount unhedged. If you just hedged it once, that was a 50% return instead of 100%. But if you did daily rehedging, that ended up being a 125% return, because at the end of the week, there was a $122 profit on the 98 cents that you were risking. So you made your 98 cents back plus 122. Okay. So it's 125% return. So that's the difference between these three different methods. All right, let's go back up here. So now we looked at these three metrics, right? These three metrics. The next metric is the standard deviation of the returns. And what this is letting us know is the following, that we see the average return 56%, but how consistent was it? Because if it's 56% week after week after week, all 12 weeks, then it has no standard deviation, right? Every week it's the same thing. If there's a small standard deviation, like some weeks it's 55%, some weeks it's 57%, well, that's really close to 56%. So we'll have a very low standard deviation, like 1%. But here you see this does have a big standard deviation, 111%. I mean, there's some weeks that you made 0, some weeks you could have made 200%, 300%, other. So that's letting us know from week to week, how do the returns look like? If we around the average, we want to see the variability around the average. And you can see each one of these metrics is telling us something a little bit different about this strategy, so we can make a much better evaluation, right? So here we see that the put, the hedging the put, the standard deviation is lower than the call. So so far from all these, the put looks better than the call. The standard deviation in the straddle is much lower than here, right? So just looking at this, we can't tell. So what we would want to do is take the average return divided by the standard deviation to see how much return do we get for each unit of risk. And that would be this. So the higher this number, the better. So here, so far, just looking at these metrics from a historical perspective of rehedging, the put looks like a better deal, right? It was a higher return. On average, it was a higher return based on the median return. And as far as the return goes as a unit of risk, based on the standard deviation of the returns, that's also a better do. Okay. So these last two metrics, and then I'm going to let you guys go. So what about the range of returns, right? Now that we know these averages, median, standard deviation, what about the simple range? What was the max drawdown, right? What was the worst return in those 12 weeks? And what was the best? So you can see here, just this straddle alone, the worst was 53%. So if you just bought the straddle, held it to the expiration, did nothing, you lost half the value in the last 12 weeks. That was the worst. So we could open that up and look through the straddle. Remember doing the rehedging. Okay. So we could find, here's the worst one on this date. All right. What about the best one? The best one was 148%. So this seems pretty good because the best one was 3 times better than the worst one, right, in the last 12 weeks. So that, at least from that perspective, that looks pretty good. Here we could see the rehedging, though, you could go more than 100%, right? Because once you start hedging, you can lose more than 100%, because if that stock floats to your long strike, you can lose on your hedge and on the option at the same time. So here there's a bigger spread to the downside and to the upside, 174% versus 352%. Okay. And on the put, max drawdown was negative 62% versus max gain of 295. So again, just comparing these three versus each other, just comparing these three in our simple evaluation, it looks like from the perspective of trading the implied volatility versus realized, the out of the money put, 25 delta put, was the better choice. Okay. So hopefully this was helpful, everyone. I'm going to let you go. It's after 9:30. Thursday, again, Will and I are going to a business conference or an industry conference. So we're going to be out. So no show Thursday.
No show Thursday. We did have a question from Rob we can get to tomorrow. He was asking about is there a way to screen for ETFs that exposed to the muni bond market? So maybe that's something we can do tomorrow.
Okay, yeah, we'll take a look at it tomorrow.
Awesome. Thanks, Steve. Great job.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day.